Madanagopal and Ramu from Sundaram Alternate Assets joins us to discuss market fundamentals and its top sectoral picks. Thank you so much, Mr. Ramu, for joining us. First up, your view on the tariffs. Which are the sectors now you feel post yesterday's sell-off look attractive, and which are the sectors you will avoid post this particular development?
The way we are trying to keep it is very simple. We are trying to focus the stocks that we own and what is the earnings growth in those stocks. The majority of our allocation is in domestic driven, domestic capex and domestic consumption driven. We have very little weights, we are underweight on both IT and Pharma, which is right now being the most talked about sectors at this point of time. So to that extent, does it worry what is happening around us at this point? Not really. We have some exposures, but they are very low compared to the overall. We are underweight in those spaces. We will continue to keep looking at these two spaces. We feel so the base case that we are assuming today is a lot of noise will be there. But what eventually happens in these two sectors might be the end result might be much lower than the fear that is getting created at this point. It's too early to say where we are heading to, but there is certain contradicting factors here to really feel that Mr. Trump's administration will achieve this inflation target, growth target, along with this tariff and trade surplus thing that they're trying to address. It's contradictory in nature, right? So it's not going to, we probably seeing a fear that is getting into the market. The end result might be much different. So we have cash in our portfolios at this point of time, and we are slowly evaluating opportunities in sectors where this fear is creating value zones. We are not in an urgency, but we definitely feel the end result might be very different. And therefore, you have to start looking at these sectors wherever there could be value zones created. But there is no urgency here. I think this fear can give you opportunity to enter into some of these sectors at a really good value.
So the value sectors, which are IT and Pharma, and how far are we from getting to the value zone?
Again, I said, I think this noise will take some more time to kind of settle down, because what the negotiation that is being talked about, both on the tariff side as well as on the trade surplus side, while on the tariff side, a country like India has nothing big to lose, in our opinion, from our numbers. But on the trade surplus side, we can still address it if given a certain time period, like probably over the next 2-3 year time period. But imagining the same thing to happen for Europe and Japan and other countries, it looks very difficult. So to really decide on what will happen to the global economy because of all this noise, it's beyond our, I think, beyond our ability to think through. But what we are saying is keep it simple, work on your domestic companies, wherever you have exposures, you can be there, because I don't think domestic economic growth is suffering because of all this to a large extent. And we have large exposures there. We have cash, and we are slowly evaluating IT and Pharma from that perspective, particularly IT. We feel that 10 to 15% correction in some of very good growth stocks, we can start getting some entry point. But I think we are not in urgency here. The base case that we are assuming is things will not be dramatically different from what they are right now from a demand perspective in these sectors, while this noise can throw you opportunity to make good entry points.
Understand that. Within IT, would you look at large caps? Would you look at the mid cap names? And in terms of sectors, would you look at IT companies with exposure to the BFSI or to the auto space? Where would your preference lie?
Maybe mid caps. 2-3 ideas we have always played, and because of valuations, we exited these ideas last year. But if we are able to get them at a really good bargain, we don't mind getting into them into these names, because there the growth is pretty good. With large caps, we have worry that the growth can be structurally much lower. It can be in single digit for a long period to come. But with some of these mid cap names, the growth has been pretty interesting, and we have sold them, and they were trading at almost like 50 times plus sort of valuation. If you can get them at less than 30 times sort of a valuation, why not? Unless you have a different view on their demand scenario going forward, which is that's why I said we feel that these are certain sectors where to really think that it will shift to US is a very big call. And I think the end result might be very different.
Okay, and in terms of pharma, what is it that you're doing? Do you like the API names? Do you like the generic names, or is it a complete avoid? Before you answer that, Mr. Ramu, our ticker team just alerts that as you can see at the bottom of your screen, Union Bank has actually gone ahead and given its Q4 quarterly update, and the company has missed both its loan growth as well as deposit guidance by a significant margin. It has missed even the revised guidance that it had given mid-year, and the loan growth at 8.6% versus a guidance of around 13%. A significant miss coming in over there. Mr. Ramu, while you answer the question on pharma, are you also worried about the BFSI space, or do you find value there?
No, I think BFSI, it's a purely domestic story, right? And I don't think there is a big growth. The slowdown in the economy in the first half of this year is now recovering back. And a lot of effort has been taken by the government, both monetary side as well as fiscal side, to support the growth and consumption. So we feel that domestic consumption will come back in FY26, particularly the second half. Therefore, BFSI consumption both looks interesting. Within BFSI, we have always been playing only NBFCs. So in NBFCs, given the regulatory related noise that was there last year, and therefore the valuations were lower, this year we are seeing growth is not slowing down. We saw the Bajaj Finance number yesterday, right? The growth is not slowing down. We are hearing the similar sort of outlook from other companies that we own as well. So growth is not slowing down. The credit cost issue is it's getting resolved slowly and steadily, which got gone into in unsecured loan and MFI loan. That is also getting resolved now. With all this, I don't think we can be very negative. And given the noise that is surrounding the IT and pharma space, which forms almost 20% of the index, if I'm right. So you can't go so negative on the financial space. And within financial space, NBFCs likely to deliver much better growth as well as earnings growth, loan growth as well as earnings growth. So that's a space that I'm not too much worried at this point of time.
Mr. Ramu, any specific views, especially when it comes to some of the old economy stocks? So you did speak about domestic theme, something that you like. So do you like capital goods name, utility names? What are your preferences there?
We are playing one as NBFC, as I highlighted to you, because this is a play on the income growth in the country, per capita income growth. Similarly, we have a similar view based on per capita income growth. Consumer discretionary looks interesting, and with the government taking effort to support the consumption this year with tax cuts, and also there could be some rationalization on GST. Also, we hear, which if it happens, it's again a good boost. So all these are leading to a situation that domestic consumption will be focus area for the government. Government spending also has improved, right? So consumption looks interesting. Consumer discretionary within that looks interesting to us, and we have been always bullish on that space. Within infra space, power sector looks pretty interesting. I think the power sector capacity creation slowed down during COVID. It is not coming back in an urgency. There is capacity constraint globally as well as in India. And this will take a lot of time to get addressed. And Chinese competition is not there after so many years of this sector getting impacted. So power sector equipment manufacturers, we are bullish, and it is reflecting in the numbers of these companies. You see the Q3 earnings growth when the slowdown in the earnings of Nifty is almost like 5% growth, right? So our portfolio delivered almost 20% growth in terms of earnings. So it shows our portfolio is positioned towards growth sectors, and the earnings growth is still continuing. To that extent, again, to repeat, if you are focused on the stocks that you own in the portfolio and their earnings growth, and if it is more domestic driven,
Mr. Ramu,
it's not something worrisome.
Right, we get that. Thank you so much for joining us and giving us your take on the markets on a day that's once again marked by quite a bit of volatility. Time now for a short break. We'll put the spotlight on the IT sector and the likely impact of Trump's tariffs on the quarterly performance of Indian IT companies.